I think that people who don't have, call it 20% or 30% of their investable savings or assets in things that represent, tangible, sound money, I think they're going to experience regret in a 10-year time frame. Bitcoin's going to multiple millions of dollars per coin, and it's at 100,000 right now. Yeah. My sense is this is just the beginning of a trend. There's some people say, well, gold's run awfully far, or Bitcoin's run awfully far. It's got to be a bubble. It's going to come back in. And I say, no, au contraire. We're actually just getting started.
Lawrence Lepard opens with a stark and sobering warning. The world is drowning in unsustainable debt. He emphasizes that global debt is growing exponentially, far outpacing the growth of real economic output. When financial claims rise faster than the production of goods and services, history offers a clear roadmap of what tends to follow. According to Lepard, we're heading toward one or more of three painful outcomes: a major monetary reset, a full-scale economic collapse, or a prolonged period of severe inflation. And often, it's a combination of all three. He argues that the YE system is mathematically broken, and we are now witnessing the early signs of its unraveling. Like and subscribe before the Fed prints another trillion.
The mathematics of the situation suggest that we've got too much debt. The debt claims are much larger than the underlying goods and services, and that typically, historically, leads to either some kind of a monetary reset, some time of a collapse, like the 29 and 30 depression, or it's seriously high inflation, or some combination of all three of those. Very hard to know exactly what's going to happen because we really don't know what the government's going to do, what the policy moves are going to do. But what we do know is that if you grow the rate of debt in excess of the rate of GDP, eventually you run into a problem because you have to, suddenly print more money in order to be able to pay the interest on the existing debt. And we really are in one of those situations where, all of the monetary rules are changing. And so the average investor or average person trying to figure out where to put their money, what to do with it, how to protect themselves, in the next 5, 10, 15 years. And the government can't print gold, and the government can't print Bitcoin. The government can't print silver. Government can't print real estate either. Real estate's got some issues with taxation and so forth. So my number one investment choice is Bitcoin, but gold is quite closely right behind it. So I think that people who don't have, call it 20% or 30% of their investable savings or assets in things that represent, tangible, sound money, I think they're going to experience regret in a 10-year time frame. And by that, the things I would put in that bucket would be houses, because you can't print them, silver and gold, because you can't print them, and Bitcoin, because you can't print them. Stocks, I would put they're kind of in the middle. It depends on which ones, it depends on what timing, it depends on valuations. The stock market's pretty overvalued right now. But in general, stocks always reprice in whatever the new currency is. So even if we go through a currency event, stocks may go down for a while, but if they're sound companies doing sound things, they'll reprice and be good places to have capital. Gold, silver, Bitcoin, and the dollar, they're all legal tender, and we let them compete with each other. There's no capital gains tax on any of those. I mean, you don't pay a capital gain on the dollar. A dollar's just a dollar. If gold goes up in dollar values, there should be no tax on that because these are all forms of money. So I'd start there. Then I would say we should eliminate the Federal Reserve, just literally shut it down. If we want the dollar to survive, we should either back it by gold or back it by Bitcoin or some combination of the two. And, that would make the dollar sound. If not, I think the dollar would go away in a freely competitive system. And that really kind of represents a reset where, the government might come out and say, okay, well, we aren't going to, if the Fed's gone, so they can't print money, we aren't going to create any more dollars. The number that exists is what exists. And we're going to back the dollar with gold or back the dollar with Bitcoin, and the government stands willing to exchange the dollar for those two assets. And so they would all find their natural price against one another. Bitcoin's going to multiple millions of dollars per coin, and it's at 100,000 right now. Yeah. There's never really been a financial asset like this because it's a commodity. I mean, one's the same as the next. It's a limited supply commodity that's never existed before. And if you think about how other commodities behave, if the price of oil goes up, we'll drill for more oil. The price of gold goes up, we'll mine more gold. The price of Bitcoin goes up, doesn't matter. Same supply. Fixed. We just saw the Japanese long bond, the JGB 40-year go up. The rate on that went up really substantially, very quickly. We saw it in Britain in 2022 when Liz Truss said she was going to increase expenses and cut taxes, and their bond market went up, and she had to reverse her policies. We saw it in the U.S. in the fall of 23 when our rates went up over 5%, and the Fed immediately came out with 10 people saying, no, we're not going to keep raising rates. We've seen it just in terms of the two biggest assets. The clues that this is going on, Julie, in my opinion, are watch the assets that are anti-bubble, and those assets are Bitcoin and gold. And since 2020, the price of Bitcoin is up 2,000% compared to the sovereign bonds, the long-term sovereign bonds, and the price of gold is up 250% compared to the price of sovereign bonds. So what that tells you is that the markets are saying, hey, we don't trust these governments not to keep printing a lot of money and debasing the value of these bonds. Oh, and by the way, we do think these other assets, gold and Bitcoin, which can't be printed, we think they're more attractive compared to bonds. That's what the market is saying loud and clear. And my sense is this is just the beginning of a trend. You know, there's some people who say, well, gold's run awfully far, or Bitcoin's run awfully far. It's got to be a bubble. It's going to come back in. And I say, no, au contraire. We're actually just getting started.
Historically, civilizations have collapsed when their monetary systems became corrupted. Roman emperors devalued their currency by clipping coins and reducing their silver content. In ancient China, the introduction of paper money led to devastating inflation. Time and again, fiat currency has failed when left in the hands of governments. Lawrence Lepard points to even deeper roots, citing the Bible, where honest weights and measures are praised and dishonest ones condemned. Money, he argues, should be like any other unit of measurement, stable, reliable, and unchanging.
When Powell took interest rates up, the federal debt, the interest on the federal debt went up substantially. It was in the 400 range. It went up to, it's running at like 1.2 trillion annualized. So that happened, and that's a problem. Inflation went up a lot, and the bond market sold off. And the doom loop, as briefly described, is that the federal government runs a deficit. How do they pay for the deficit? They borrow money to pay for the deficit. That increases the amount of debt outstanding in the system. So somebody has to buy that debt, and the person buying that debt says, what interest rate are you going to give me for it? And if there's a fixed amount of people willing to buy it and the amount of the debt goes up, well, then the interest rate, by its very nature, supply and demand, it's going to have to go up too, because some people say, well, I'm not going to buy it at 3%. You got to pay me 4 or 5 or 6% to buy it. Well, that's fine. So let's say interest rates go up to 5 or 6%. And as they did, they went up to 5% in the fall of 23, and the Fed panicked. That's when they talked about they weren't going to keep raising rates. And so when interest rates go up like that, it creates a bigger burden for the federal government, because the federal government's got $37 trillion of debt. And, this year alone, 7 to 9 trillion, depends on which estimate you believe, are going to roll over. So higher interest rates, that rolls over. Well, then they got to pay more on the debt. Well, that paying more means that deficit gets bigger. That means they got to sell more debt. You see what I'm talking about here? It's like a vicious circle.
That is the doom loop.
That's the doom loop. So, okay, hang on a sec. So you got to sell more debt. Well, you sell that debt in the market. Well, that means you're going to push the interest rate up. Higher interest rate. That means you're going to have a bigger deficit. That means you got to sell more debt. So that's the doom loop, and that's kind of the bigger picture of what's going on. And I don't really know how to get out of it. I mean, without the currency collapsing. That's the problem. Money really plays two different roles. One, it's a savings vehicle. You hope to retain value through time and space. So if you do some work, and you don't want to eat today, but you want to eat in the future, you save your money so you can do that. And then money also is a medium of exchange. You use it to buy things and trade for. And when you're using it as a medium of exchange, the inflation is not necessarily as important, because you might get money and spend money, and you don't really see much slippage between the time you receive it and the time you spend it. But as a store of value, it's very important. And over time, what happened historically in the world is that humankind, kind of naturally, not driven by governments, gravitated toward forms of money which couldn't be debased. And we tried a lot of different things. I mean, seashells, tobacco, you name it. But 5,000-6,000 years of recorded history, and gold and silver kind of became the de facto accepted best forms of sound money. And the reason is that they are geologically limited in their supply. The supply of gold grows at 1.7% a year. And so, for money to have value, it's got to be scarce. This is why monopoly money has no value, because The Parker brothers can print an unlimited amount of it. And so, and in theory, when the U.S. was behaving responsibly, and when we were on a gold standard and the dollar was backed by gold, well, the dollar was sound. But what slowly happened, as the book describes, is that we just kept knocking out the little, the supports underneath the dollar until eventually in '71, Nixon locked out the very last one. And now the dollar has no backing. I mean, it's backed by the faith and credit of the federal government, which, how good do you think that is, given all the deficits they're running in their balance sheet? So, but sound money was always money which was scarce, which could not be just, printed out of thin air. Fiat money, the experiment started hundreds of thousands of years ago. The Chinese tried it, others have tried it. Fiat money was always by definition money that governments by fiat said, this has value, and I declare that it has value, and you will accept it. And, if it was done responsibly, if a government said, well, gold and silver, will be money, and they'll be we'll make coins, and they will be made of gold and silver. So there's intrinsic monetary value there. Well, then the inflation might have been lower, although, people tended over time, what they did was they clipped the coins, or they would dilute, like in Rome, they started off with silver coins, they ended up with iron coins, and so, there's been a trend all throughout humankind for, this goes back to the Bible, right? There's a chapter in the book called, sound money is a moral issue. And I really believe it is, because people in general, we're not all perfect, and people will try and cheat if they can. And, the authors of the Bible know this, because they talked about using honest weights and measures, and saying cheating in weights and measures is an abomination to God. And so, basically, money is a weight or a measure, and it ought to be sound in the sense that it shouldn't be variable. An inch doesn't vary, a foot doesn't vary, a gallon of water doesn't vary. We have measures of things, and yet we've got this elastic currency that is always continually kind of losing its value. And so we're trying to build an economy on something that is always moving around. And that, from an engineering point of view, I think engineers can understand that that's just not going to work. If the definition of a foot varied all the time, how would you build a house? So, that's another way of kind of looking at it.
So what does all of this mean for you? We're living through an era of unprecedented monetary experimentation and fiscal irresponsibility. Debt levels are soaring. The dollar is losing its strength. And the traditional tools, central bank policy, low interest rates, and global demand for U.S. debt are failing to keep the system stable. But as Lawrence Lepard reminds us, there is still a path forward, one rooted in sound money, transparency, and individual sovereignty. Still stacking. Knowledge? Good. Hit that next video.